We're going to have a correction. Markets are very, very overbought. You're going to have a pullback.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back here at the end of another week for another weekly market recap featuring my good friend, portfolio manager and bond villain, Lance Roberts. Lance, how you doing?
I'm doing fine. How are you today, Adam?
I'm doing great. Look, went with bond villain because we're going to be talking about bonds today, both U.S. bonds and Japanese bonds.
Okay. Give
But
me a
also,
short conversation.
it might be. Give me your best Dr. Evil answer to this question. How many assets under management does RIA have?
Right at 2 billion.
No, you did it wrong. Supposed to use your little pinky,
Oh,
right?
2 million. So,
All right. Well, look, lots to talk about, and we are back-ended today, folks. So I'm going to be powering through a lot of topics quickly, unless the bond answer is indeed a very short one, and then maybe that buys us some time, Lance.
yeah.
First off, folks, just want to thank you. I made a plea last week for you to help get my X account above 100,000 followers, which you did. So congratulations, folks. I appreciate the help there. And I will probably come back at you soon to do the same thing for my Substack, but we'll save that for another video. All right, Lance. The big question that I think is on everybody's mind right now in terms of the stock market is we've seen a lot in the month of May of the market recovering the losses that it had in March and April. And so the big question in everybody's mind right now is, okay, so was the whole March-April dip, was that just a correction in an otherwise continuing bullish uptrend? Or is what we're seeing here in May a classic bear market rally, right? That gets everybody confident, gets them back in the pool, and then pulls the rug out from under them.
Well, you and I talked about this last week, and I said that if the market can hold above the 200-day moving average this entire week, the correction's over. We've done that. Well, now we're talking Friday morning here, and markets opened right at the 200-day moving average this morning, bounced off of that early going. So, but again, markets are really, really overbought here. So we're going to get a pullback. And just because we get a pullback doesn't mean it's a bear market rally. So it's just, we've gone very far, very fast. You need a bit of a correction here. We've been taking profits over the last couple of days. We've raised cash levels to about 17% of the portfolio right now, where we've taken our hedge. We had a short position that we've removed from the portfolio as well. So we're getting ready for this market to pull back a bit so that we can then take portfolio allocations back up to full weight.
Okay, and maybe if you can, we might want to start pulling up the TA here. But let me preface this by saying I've talked to a lot of technical analysts over the past week, and you always give us an update on these weekly recaps, and I'm looking forward to hearing your latest one in just a second. So talk to Sven Henrik, who basically, I think, said more or less the same thing I've heard you say in the past, Lance, which is this is the bull's market to lose at this point in time, right? He basically says it's kind of do or die time for bears. If they're going to prove right here, it's got to be soon. He looked at a lot of the same indicators you did, and that if the bears don't kind of prove it kind of this weekish next week, then it's going to be clear sailing, he thinks. Now, I just interviewed Mark Newton, who is works with Tom Lee at Fundstrat. So probably not a shocker, but Mark thinks that things are going to be quite bullish from here through the fall, looking at his technical models. And then I just interviewed Tom McClellan, who that interview is going to come out the day after this one. And Tom basically is saying, look, all things being equal, he thinks that this is more likely to be a bear market rally and that things are going to degrade over the coming summer. So it's really interesting that I'm talking to all these different technical guys, and they're kind of telling almost three different stories, kind of a, too hot, too cold, just right story. So anyways, curious to get yours in the mix of that soup.
Well, they just basically, when you look at technical analysis, it's like meteorology, right? So you're just trying to take, pieces of data and then try to make a projection, and projections can always be wrong. And that's why it's important to manage risk. And again, I don't really care whether or not this market's bullish or bearish over the next, 3 months or so. We're going to have a correction. Markets are very, very overbought. You're going to have a pullback. Friday was probably the start of that corrective cycle. And again, as is always the case, when markets are going up, you get a lot of people very bullish and sellers don't want to sell. So it's like, why would I sell here? Because prices are still going up. So you need some type of event or some type of catalyst to get sellers to go, okay, I'll sell. And that's why markets have these corrections over time, 3, 5%, whatever they are. But just because you have a rally and then a pullback doesn't mean it's a bear market rally and you're going back to new lows. And again, I've laid out that analysis before, that where this market looks a lot like 2022, where you had a bullish rally, then you had a corrective rally, a corrective sell-off that took us to new lows, and then a rally, then a corrective sell-off to the October 2022 lows, and then the bull market resumed. Could we be in that cycle? Sure, absolutely. The market is set up, that analog is certainly still very much in place right now. So sure, this market could pull back. Again, I don't care. That's why I'm holding 17% cash, because I want to buy stuff at cheaper levels. I don't want to buy highs. I want to buy lows. So, that's the whole purpose of managing a portfolio. So it doesn't really matter whether it's a 5% correction or a 10% correction, whatever it is. A correction is a correction. And when markets get back to very oversold conditions, you want to be a buyer of stocks.
Okay. So, this is kind of, I guess, consistent with what you're saying at the very beginning of the year, that this year is likely to be a lot more volatile than what we've been used to in the past couple of years, which it has certainly proved to be.
It's also what we wrote in Curb Your Enthusiasm.
Exactly. Back to your Curb Your Enthusiasm. So what you want to do is kind of play the swing trades here, right? When it's oversold, buy. When it's overbought, sell. And it sounds like, if I'm hearing you correctly, in the near term, like kind of the immediate term, you think market's overbought, you think the likely price actions to the downside, and you are more or less positioning as such.
Yeah, exactly. I mean, just like we were buying on April the 7th, we're now taking profits out. Like we bought Palantir, we bought NVIDIA, we bought Google and some other stocks, back on April 7th, April 8th. And so today we actually sold, reduced those had, like Palantir's up like 60% from that buy point. So we reduced it back to target weight. So again, we're not selling everything. It's just we're reducing stuff back to target, raising cash. And so now we're sitting on a bunch of cash that we can take our time with. I bought a bunch of 30-year bonds yesterday morning, very early, right at the market open yesterday. I bought 30-year treasuries because bond yields are extremely oversold here. So you're going to get a reversal in yields. And of course, we did that yesterday. So yesterday we had a really nice bond rally yesterday off that buy. So again, that's been helping hedge the portfolio as well.
Okay. And I do want to get to bonds in a moment. And look, full transparency, folks, hopefully Lance's audio is good this week. He's back on his old computer, right? Because your main one gave up the ghost again.
So yeah, I'm on my temporary kind of backup computer at the moment. My primary has been having problems ever since I bought it, and Dell's tried to fix it 3 times now. So it's now going back to the shop for the 4th time. They're just going to replace everything. So basically, I'm getting a new computer this coming week. So we'll see what happens.
Okay. But I don't know if on the current one you can do it easily. But if you can bring up the chart of the S&P, Lance, let's just see where we are on that key moving average indicator. And remind me, which one was it? Was it the 200-day?
The 200-day, and we're sitting right on it. So this is the rally from the October 2022 lows. And you can see in the momentum we've had such a huge momentum swing. We went from very, very oversold momentum wise. This is why this was such a great buy setup. When everybody's talking about, the market's going to crash, I was like, no, this is going to be a great buy setup. And we wrote that article called The Hope and the Fear on April the 6th. And we said, there's so much negative sentiment, so much negative bias. This is a buy opportunity for stocks. And it's been a great one. So stocks have had this huge rally, but momentum is extremely overbought. We're more overbought now than we've been in 2 years. So you're going to get a pullback here of some level, probably pull this MACD back towards 0, maybe a little bit less. So again, the market can certainly trade down to around 5,600, which is where the 20-day moving average is right now. Sorry, the 50-day moving average is right now. So, we've got the 100 and the 200 kind of sitting, right on top of each other. So you've got a lot of support sitting right below the market. It's down to around 5,600. We could get down into, kind of this previous, kind of tariff area. We're around 5,400. I wouldn't expect much more of a decline than that. We're going to work off this relative strength overbought condition pretty quickly. But again, the markets were just so overbought and so extended. You had to have some type of a pullback here. So this is why we've been talking about the last couple of weeks. Take some profits, rebalance risk. do some things to hedge your portfolio, because you're going to get a pullback, and it's just taking a little bit longer to get here than we would have expected. But again, you move from 3 standard deviations oversold to two standard deviations overbought. So again, this correction is not surprising.
Okay.
It doesn't, and by the way, it doesn't mean anything. It's just a correction.
Yep. Yep. Not the end of the world, just a correction that you would expect to see in a natural short-term market cycle, especially in a volatile year like this year. Let me ask you a question. That pink circle at the top in the MACD, were you just highlighting that reversal, or is that a sell signal?
It's not a sell signal yet. It's going to be. I mean, it's going to trigger, because this correction will probably continue into next week. We either the market just starts grinding kind of sideways, we get a little bit more of a pullback next week over some other piece of news that comes out, whatever it is, inflation numbers or the Fed or whatever. Somebody will say something, and this market will sell off a bit more. So we'll definitely trigger a sell signal. If not today, by the end of the day, depending on where the market closes, Monday, Tuesday next week.
Okay. And then let me ask you, in the middle of your charts in the past, you had a tracking of net capital flows in the market. And I'm just curious, do we have that here somewhere?
I can put it on here. Hold on real quick. So yes, money flows have been very positive, and they've started to turn down here just a little bit lately. Here, I can zoom in a little bit. But see, this goes back to this low. We had when we had this low in the market, you had improving money flows. That's what they call a negative a positive divergence. So you had improving money flows, even though the market was selling off during into Liberation Day. This was also one of the reasons why we talked about the hope and the fears, that there was so much fear mentally in investors. They weren't paying attention to what was happening with money flows, and people were buying the market. In fact, that's kind of the subject of this weekend's newsletter, which is retail investors, which have, like last Monday, they poured $4.1 billion into stocks last Monday. So, again, retail investors have been heavily buying this dip the whole way up, while hedge funds and professional managers, they've been getting more and more short, hedging more risk, raising more cash. So, they've been very, very behind the curve. And so hedge funds in particular, they really need a bit of a pullback here so they can get their allocations back on the right side of the trade.
Okay. And with retail piling in, does that kind of give you the sense of, all right, sort of the not to be insulting, but the dumb money is coming in here, and that makes the recent rally long in the tooth?
Well, that's an interesting point, because typically we historically we have deemed retail investors as dumb money, but they've been calling this market right for the last 5 years. It's been professionals that have called it wrong. So, you take a look at coming out of 2020, they were buying the market while professionals were shorting the market. Professionals were out of the market. They were heavily buying. 2022, all the way down, they were buying this market all the way down. It took professionals about a year and a half after the bottom to get back in the market. So retail has been calling this market a lot better than professionals have over the last really 3-4 years.
Interesting.
So I don't know if that's just, maybe they're getting lucky, or maybe they're just getting smarter because they all have access to AI and tools now. So we'll see if that continues to be the case or not.
I also wonder too if it's maybe just a function of the giant mindless robot.
That's a lot of it. People keep counting out, the Mag 7, but they're going to generate 50% of the earnings growth over the next 3 quarters. And, they have certainly outperformed, a big chunk of the market recently, because when these retail investors pile into leveraged, Qs or leveraged spiders, whatever they are, and they've been trading a lot of leveraged ETFs, that's all just dumping money, directly into these Mag 7 stocks. And, they continue to perform well.
Yeah. Not to get sidetracked on this, but,
Sure.
I mean, there's lots of concerns that folks can raise about market concentration, Mag 7, valuations, all that type of stuff. But how compelling do you find the simple argument that, look, if a recession just doesn't materialize, to reduce the monthly inflows of that passive capital coming from retirement funds and whatnot, then we should just expect to see business as usual continue?
Well, I mean, it's, look, there's a whole group of people that build their entire livelihoods around being as bearish as humanly possible because it gets clicks and views and those type of things, so they can sell their newsletters or whatever it is, and that helps. So that helps that group. So, you know, and that's your model. That's fine. That's not the point. The point is that as investors, we have to simply navigate markets for what they are. And I think we spend way too much time worrying about things that don't really matter in the short term. And when you start worrying about things that may take 3 decades to mature, 5 decades to mature, you're not probably going to live that long. And more importantly, our job is to make money. We've got money invested and we've got to build wealth in order to get to our retirement goals, whatever they are. And worrying about a lot of these big macro issues that have either no impact on you directly or no impact on the markets near term, really just winds up helping you lose more money, either through lost opportunity or just making bad investment decisions, than just paying attention to what the markets are doing and just trading the market that you have. And so, yeah, market concentration is certainly an issue, but we've had market concentration in markets before. And yeah, you either go through at some point a secular bear market that reduces that. We don't have any indications of that right now. You need some type of event to make that occur. Or the market will just simply grind its way out into another area of the market. So again, the Mag 7 leaders that are today potentially aren't going to be the Mag 7 leaders of tomorrow. The Mag 7 leaders of tomorrow may be companies like Palantir, Palo Alto Networks, Anthropic, a lot of these other AI companies are coming up. Apple, we've sold our entire stake in Apple.
No way.
Yeah, because it's no longer a growth company. It's no longer growing earnings at the rate that it needs to support its valuation. So we've sold our entire stake in Apple, and we're going to be adding Meta to the portfolio because it is growing earnings.
Is it going when I get to your trades, is that something you did over the past week or
this morning, actually, at the open?
Okay. And of course, huge news at the open today too was that President Trump said he was going to place a 25% tariffs on Apple iPhones that weren't manufactured here in the US. And so
and they can't manufacture iPhones in the US. So if that tariff sticks, then that's going to be a problem for their growth. But at the end of the day, it's all about revenue growth, and they haven't grown revenues really in 5 years. So
well, and this is why I'm so curious okay, I got to make sure we don't take too many detours here, but this is fascinating. So I have been saying for a long time about Apple, how is it maintaining its stock price growth? Yeah, I mean, but yeah, because this is a company that for many years recently didn't grow its revenue at all, and to your point, its earnings growth hasn't been blockbuster either. So, I'm still wondering why Wall Street hasn't quite got the memo yet. But it sounds like you guys got it. What was it about this week that made you guys say, okay, you know what? Because it's not like the revenue and earnings growth picture wasn't clear a couple of years ago. What is it about today that made you say, okay, we're out?
Well, so it's not really a function of Apple in particular, is that we only can maintain 25 positions in our portfolio. So we run a fairly low number of equities in our portfolio, and that helps us generate outperformance over our benchmark by having fewer holdings, because we can selectively pick companies that can help us generate outperformance. Like, for a good example, Palantir was a huge winner this week. Well, it's not really in the top 10 stocks in the S&P. And for instance, yesterday we had a big win over our benchmark yesterday because Palantir was up like 4%. So it's a 4% position generating a 4% return. That's a 16 basis point increase in the portfolio all by itself. So, that type of asset selection gives you better total return performance over time. And so we're looking at the portfolio going, okay, and look, we're not denying the reality of the giant mindless robot of passive investing, because that ain't going away anytime soon. So our question is okay, we're going to concentrate our holdings. We want to have bigger holdings in the stocks that are that have the most earnings growth and drive the most returns in the market. That's those top 10 stocks. Well, I can't own those 10 companies in a portfolio of 25 stocks because it would be my whole portfolio, right? So I've got to selectively pick 4 of them that I want to own that have the highest earnings growth, have the highest concentration benefit from passive investing, and that's Microsoft, Google, NVIDIA, and Meta. and then Amazon also in there. So so we're gonna, yes, we're selling Apple so we can use those funds to add Meta to the portfolio, which we don't own. And
Yeah,
Meta has a
got it.
much higher earnings growth profile than Apple does. So
Okay.
it's simply not a function. We don't like Apple. Apple will be fine. Apple will do well. We've owned Apple for ever since we started that portfolio. Apple was one of our original purchases. We've made a ton of money buying and selling Apple along the way. But it's just time. If we want to create better performance in the future, we need to focus more on earnings growth.
Okay, totally get the logic, and maybe you've already sort of answered, but I was just curious, what was it about this week where you said it is time? Like, was it, oh, Meta just outperformed even more and we just can't ignore it anymore? Or what was it that made you say this is the week to sell it?
Well, it was it's never that way. I guess, it's not like we focus on stuff in particular. It's just as we talk about themes and transition and those type of things in the market of what's going on. It wasn't any particular trigger that said, okay, this is the week to sell Apple. We've been talking about this for a month. It was just, kind of to the point. And this morning was just another impact. Well, if they've got to now pay a 25% tax on iPhones not made in the US, and they cannot manufacture iPhones in the US, then that's just another blow to their revenue growth. So we needed to raise cash some more today just because we're going to go through this corrective cycle. And it was on the chopping block. So it got chopped.
Okay, great. I'm going to get back to my previous question, and we'll get to bonds. So on the giant mindless robot, which again, folks, is passive capital flows that enter the market every month as corporations have to buy stock for their the retirement funds of their employees. And that's a price insensitive buyer that just happens every month, doesn't matter what the current price of the market is, and that the formula by which that capital gets allocated in the market favors the Mag 7, right? A disproportionate amount of that capital going in the market is buying those few stocks, and that's what kind of keeps them propped up. We could talk about all the ways in which the market could go sideways, Lance, as you were sort of mentioning earlier. You said there's got to be sort of a trigger, and that was, I'm trying to be real simple here, but
Yep.
The big trigger for the giant mindless robot, or the big obvious trigger, is a recession, which means there's just less money, that monthly buy capital flowing in from the giant mindless robot starts to flatline or potentially contract, right? So, so my question was just basically like, the giant mindless robot is a big juggernaut. It's a dangerous one as an investor. Yes, you can be really worried about current valuations, but as you've always told us, that's a terrible timing metric. And as long as that juggernaut is rolling along, it's one that the individual investor probably doesn't want to stand in front of unless there's a clear trigger like a recession. So my question was, and I realize this is very broad, but like if you're a regular investor, it's kind of almost like, don't pick a fight with a giant mindless robot unless we're going into a recession. Would you say that's wise advice?
Well, it depends on what kind of recession you're talking about. So the problem with the giant mindless robot is what you talked about. It's just people that are just on auto contribute 401k plans, IRAs, investing accounts. I'm automatically drafting my account, throwing it in the S&P index. And this has been something that's just been drilled into investors really over the last 30 years by the mutual fund industry, because so we have to go back a little bit. In 1980, there were basically like 5 mutual funds, and Wall Street said, we're every day we're out here trying to sell a stock to somebody. We're a sales business, so every day we got to sell a stock to get a commission. We get the spread on the commission, and that's how we make money. And so what if we could just convince all our investors to just put money into a fund where we just charge them a fee? We can just annuitize our business. January 1st, boom, we turn on the lights. We already know we made $1 billion this year. Great. Then just whatever new money we get this year is even better. So we need a storyline for that. And so the storyline is, hey, don't worry about the market up and down. Just invest in the index. It goes up over time. You'll be fine. Don't worry about it. So we've just been indoctrinating investors for decades on this. So you had to get all the old investors out. You had to get the boomers out of the market. You had to get a lot of the Gen Xers out of the market. They had to get to retirement, because those were the guys that, hey, you know what? I've been through these market cycles before. I don't want to go through these big downturns. But now you got this whole group of people that are over the last 15 years in particular, because of the Fed and central banks and everything else, and going, hey, it doesn't matter if the market goes down. central banks are going to bail it out. It's going to go back up again. So I'm just going to keep sticking it in. So my point about recession is you could have a recession. We could call 2022 a recession. We had slow economic growth. The market declined. I mean, it's we didn't have an official recession, but recession wise, it looked a lot like there was a recession
Right.
in
We had a
2022.
technical recession, if I remember correctly. We had 2 quarters, I think, of back-to-back negative GDP growth. Yeah.
Right, right. But you didn't have employment fall
Right.
off the cliff. So the National
Right.
Bureau of Economic Research never said that the recession. But what I'm saying is just technically, you had a big decline in the markets. You had a lot of mid cap, small caps get ripped, in that market. Investors lost a lot of money, but they just kept piling in again. So that type of recession, it didn't deter passive investors, and as soon as that market bottomed, they were just piling back in again. So you're going to need something like a financial crisis that actually kind of devastates the markets to where there is no earnings and there's so much concern about markets and just trying to meet day-to-day living requirements. I don't know if I'm going to have a house tomorrow, I can't pay my bills. You're going to need that type of event to get people to extract capital out of the ETF market. And then if you can extract capital out of the ETF market, there's your problem.
Okay. And the reason why I brought all this up is you made a comment earlier about like, look, it's a correction that you're expecting. It's not a big deal, right?
Yeah.
And what I'm trying to sort of help the average person understand here is like, yeah, like, to your points from previous videos, Lance, market starts rolling over in the calls of like, all right, this is it. This is the big one, right? And I think you're basically saying that's a very tail end risk. And so if we don't have the type of severe recession that you just described, expect it to be more, trading cycles, trading ranges, right? And play that with a fair degree of confidence. And don't worry about so much about the nuclear, downside unless we
Yep.
start seeing something like the type of recession that you mentioned.
Yeah, exactly. Like we're on a weekly sell signal right now. We've been on a weekly sell signal since, pre-tariff. And that we're still on that sell signal, which just means that doesn't mean that markets just inevitably decline, but it can just go nowhere for a while. So we haven't got back to new all-time highs yet. We're not back to all-time lows. We're just in this middle range, just kind of grinding around, and that's good because it's reducing a lot of that we have really overbought markets from 2023 and 2024, those two 20% return years. We had really overbought markets technically on a weekly basis, and we've reversed 90% of that now just over the course of the last few months. So these market cycles are moving a whole lot faster because money flows are a lot faster in the markets. So, we're still grinding through that. So again, we have this correction, we have another rally. Look, right now you've got a tremendous amount of corporate buybacks going on, but that's starting to close. We're going to start closing that down next month because we have earnings reports start again July the 1st. So right after Independence Day, we'll start getting back in earnings season. So that window for buybacks is going to start closing. A lot of the other support in the market is going to start kind of fading back a bit going into earnings season. People are going to be a little tenuous about tariffs and the stuff that's going on, how that's going to impact earnings. So we could very well see June be a month where the market just, trades lower, trades more volatile, whatever it is. July tends to be a very strong month. August, September tend to be weaker because there's other impacts that come along. We're going to have the fiscal budget coming up in October. We've got to reset the budget for the next year, congressional wise. So you get the whole debt ceiling debate type worry going on, whatever it is. But there's always some event that seems like in September, October that tends to make markets trade a bit weaker. And then once you get through October, then buybacks kick back in, you get the end of the year rebalancing, you get your rally into year end. So I would expect this market to just trade sideways here for the next few months, be pretty volatile. But if you're kind of even a sort of adept trader, there's going to be some really good opportunities to pick up stocks cheap.
Yeah. Okay. And we've said that, look, this is a, much better environment for active investors given the volatility. And of course, that's letting you guys shine this year.
Yep.
From a market technician standpoint, I'm guessing the more the market grinds sideways this year makes you, I'm guessing, more bullish about the
Yep.
market's prospects afterwards, right? So if
Yeah,
you're
yeah.
overbought, you can kind of get rid of that one of two ways. You can have a big correction in the near term to get rid of it, or you can just grind sideways and let the overbought, bleed out the way that you're saying it's been happening right now.
Right, right, exactly right. And so, yeah, so a correction and a consolidation, they're both good things for markets. And again, I look, corrections aren't fun, consolidations aren't fun, but that's what you want as an investor. This is why you hold some cash. When markets are going up, we can't wait to buy it. It's like, oh, the markets are going up, I'm missing out, I got to get in. And so we're all wanting to buy the tops. And then when the market's correct, it's like, oh my gosh, you got to get out. Markets are going to crash, and then you forget that that's why you want to start buying. You want to buy stuff when nobody else wants it. You want to buy stuff cheap because it's how you make money. But people get so wrapped up in all these bullish, these bearish narratives, the end of the world, the dollar, de-dollarization, reserve currency, blah blah blah. None of that is going to impact you in your lifetime. But you missing out on opportunities to manage your money and grow it and build wealth, that's going to hurt you.
All right. Well, look, let's move on to bonds now. And Lance, you kind of maybe delivered the punchline earlier by saying that you just bought a bunch of, or you just took a position in 30-year U.S. Treasuries, expecting that yields are going to start coming back down. But yields have moved up pretty aggressively over the course of this week. We saw the 10-year, I think, at 4.6 at one point. 30-year was back up to 5.1, something like that. Highest it had been in a good while. So
Yeah.
let me ask you this first before we get to your trading decision.
Yep.
Assume yields were to continue to go up here in the short term. At what 10-year yield do things start breaking? Do stocks start breaking? Do companies start buckling?
It's
Like, where's the danger zone?
it's not the yield, it's the speed of the increase,
Yep,
right?
and we saw that earlier with the basis trade. Yep, but yeah.
Yeah. So as long if interest rates just creep up slowly, it's not a problem because markets will adapt to it.
But is
But
that really true? Like if
yeah,
they kept creeping up 6, 7, you know?
it's not going to matter. Look, I mean, and think about it this way. If I could get to a 5% 10-year treasury yield, I'm going to attract a lot of buyers. If I can just, remember when we had 5% 2-year treasuries and you were like, hey, it's T-bill and chill time, right? And I was like, be
Yeah.
careful with that because you're going to do T-bill and chill and this market's going to take off running and then you're going to try to figure out how to sell your bonds to go buy stocks that are making 20% a year, which that T-bill and chill thing really screwed a lot of investors. But at 5% 10-year treasuries, really even at 4, you attract a lot of buyers because they go, you know what, I can buy a 10-year treasury, clip 5%. If my hurdle rate in my portfolio is 6, I'm there. I don't have to have a lot of equity exposure to make up that 1% differential. So you're going to attract a lot of buyers at 5%. You get to 6, you're going to attract a lot more buyers. So, but again, you
So
have to
sorry,
put
let me just interject so you can continue, put
yeah,
this in your rest of your answer. Let me
sure.
talk to the Lance Roberts of 2, 3 years ago,
Yep.
who when the Fed started hiking, right? If I'm remembering correctly, said, "Oh, they'll never get above 3% because the economy
That's
just won't take it," right?
Yeah, I was wrong.
So
I was
okay, but
absolutely wrong about that. And
so you were
and
wrong,
surprisingly,
and by the
and
way, let me
surprisingly,
congratulate you because a lot of people don't like to say that publicly. So you did great, but okay, if you were wrong at 3, are
well,
you
no,
like, well,
there's
then it doesn't matter anymore? So 6 is fine for this economy?
no. That's not what I'm saying. It's the speed of the increase. So first of all, when I said the Fed wouldn't get above 3, the one thing I got wrong about that was I didn't realize until after that fact how much debt had been refinanced at very, very low rates for corporations. So corporations never ran into a maturity wall where they had to refinance at a much higher rate. That's
Until
still
this
out
year,
there.
but yes.
Yeah, that's still out there, right? So there is a pending risk of that. But if you're just talking about, so there's 2 risks here, is that, where's that rate where basically everything kind of gets screwed up, in the economy, probably at 5 or 6, you're going to really start to impair economic functioning because, mortgage rates are already, I mean, you just saw the new home sales yesterday were terrible. People aren't, getting mortgages here even at 7%. But if you get mortgages back to 8, 9%, it's going to really put home affordability into a real problem. And so that's going to start to impair economic growth. You're going to put a lot of the financing issues at risk. And then most importantly, and I don't know where this number is. It could be 6, could be 7, could be 8, but somewhere in there. Remember when we were at 4% ish on treasuries, we had the Silicon Valley bank crisis,
Right.
and that's because of the impairment of collateral of banks. So right now, banks are doing okay because they had that bank term funding program that kind of bailed them out, let them get rid of some of their debt on their books, kind of get things shaped up. But right now, there's a huge push to allow banks to get rid of the reserve requirement on their books, which will allow them to buy a whole lot more treasuries and put on the books so that they can increase their lending ratios. So if they do that, that's going to push yields down, pretty dramatically. And that's there's a very high probability that's going to occur within the next year. But at some
Okay,
point,
so
the Fed is going to step in. If it starts to impair bank collateral, the Fed will step in and bring rates down.
okay, so there's so much in here to address. I want to try to keep it focused, but reducing the requirement ratios and stuff, that I think that's part of the deregulation that the new administration's saying it wants to do. So it probably will happen, but unless and until it does, my understanding of the bank term funding program is that it's done.
Oh
That
no, no,
is
I'm not talking. No, I'm not. No, I'm not talking about that. That was just one program that helped
no,
kind
no,
of
I know, but let me
stabilize
just
banks.
let me just ask this
Yeah,
question,
yeah.
which is, as far as I understand, it's done. Meaning, a year ago they were shutting the door to be able to participate in it, but you could still get in before the deadline, and the government would give you would hold your debt, would hold your
Mhm.
assets, sorry, your bonds, right, your treasury bonds, for a year. But I believe that year is now over, and so all those assets, I believe, are now back on the bank's balance sheets, right?
Yeah, and that's what I said is that that gave them a breath of life and higher rates, right? So it
Right.
helped them shore up that impairment to their collateral because of what was happening with higher rates. Now rates are creeping up again, which
Yeah.
is going to start to impair their collateral
Well,
again, right?
just to be clear,
Yeah,
their collateral was returned to them in a
and now
still impaired state, right? Because rates hadn't changed very much, and now rates are creeping even higher. So
that's
my question
correct.
is, like, are banks a lot more? I would think they would be a lot more vulnerable now because they've had to take all that stuff back on their balance sheet, and rates haven't come down in the interim to save them.
Right. And we don't know the answer to that question, right? And we won't know the answer to that question until somebody blows up again. But my point is that if there's a rate, again, I don't know where that rate is, but there is a rate to where the Fed will have to step in to stabilize the banks and either have to set up another bank term funding program or go back. And they've already done this way. They've already reduced QT from 25 billion to 5 billion a month. So that's already kind of starting. It's, you're still doing QT, but it's a lot less. So, for instance, there's a big piece of misinformation running around recently, and they were showing the Federal Reserve that they bought like $20 billion worth of bonds in a month.
Right.
It's like, oh,
But
see,
they
the
have
Fed's
to.
doing QE, and
Yeah.
it's like, no, they're not doing QE. It's just the roll off, but they
Yeah.
are buying
Well, they have to
bonds.
buy bonds to maintain the ratio that they're trying
That's
to
right.
maintain, right? Yeah.
Exactly. But they are buying bonds, right? So that's now if they reverse that so if rates get to a point to where the bank stability becomes an issue, you're going to see them reverse from QT back to QE. And they'll start saying, hey, we're going to go back to 10 billion a month in QE, whatever it is. And that's going to be your sign that that rate had gotten to a point to where the banks were in trouble.
Okay. So, look, the faster rates rise or yields rise, it creates more of a shock to the system,
Mhm.
right? But just the absolute value of the rates puts a weight on the economy that at some point things start to buckle, right? And I know you're once bitten, twice shy, and you just said,
Mhm.
I don't really know what number that is, but let me just ask you, what does your gut tell you, right? At what
Probably,
10-year yield?
you get to 5 on the 10-year yield, I think you got problems.
Okay.
Yeah, but again, if it creeps up there really slowly over the next year and the economy is doing fine, look, we adapt. So first of all, let's put some things back into some perspective for just a moment, okay? Lots of rumors running around. And oh, it's the deficit and the trajectory of the deficit. Okay, first of all, we've cut the deficit in half since 2020, so let's get back to realistic levels. But take a look at the deficit. It's basically where it was in 2008, going into the financial crisis. right? It wasn't the end of the world. The world didn't end. Everything was fine. Interest rates are where they were in 2007. So we're coming off abnormally low levels of interest rates were 0.5% following COVID. So yeah, we're up to 4.5, but that's where economic growth is. So if you take economic growth plus inflation, that's 4.5. That's where we should be interest rate wise. And that's where the market was trading pre-2008. And so all we've done is just bring rates back to a normal operational level in the economy. But we were so used to low rates that now we're all freaking out over 4.5% rates. 7% mortgage rates, that is freaking cheap. If I'm going to loan money, I loan money to people as part of my job, my other job. So I charge 10 and 12% for money that I loan out. And
Yeah,
it's
but you're
fully
a loan shark.
collateralized.
Come on.
No, absolutely. And if you need money, I'll loan it to you, but I'm going to take, I'm going to get a 40% loan to value, right?
You're going to get a kidney.
No, I'm not. But, if I'm going to loan, if you came to me and said, Lance, I want to borrow money from you for 30 years to buy a home, great. I'm going to hold your house as collateral for 30 years and I'm going to collect 7% a year. I mean, that's not a great return for 30 years because that really doesn't do much to hedge off inflation, economic growth, those type of things. So, when you're talking about a 4% mortgage or a 2% mortgage, that never made any sense in the economy, but we were willing to do it because we had all this extra juice. So all we're talking about is with economic growth at 2.5, inflation running at 2.3, which is about where we've been since the turn of the century, we're just moving back to normal. And so interest rates at 4.5 is normal. And if we hang out here long enough, and this is what's been happening over the last 2 years, everybody can't figure out why this market's been rallying like crazy. It's because we're normalizing. So, higher inflation, we're getting used to it. The economy gets used to things after a while. We get used to paying for $4 a dozen for eggs or $3 for a gallon of gasoline. And then when it goes up, it's like, oh my gosh, it's so expensive. And then when it gets back to $3.50, it's like, oh, it's cheap again, right? So even though it's higher than it was before. So we're normalizing and we're getting back to normal levels of activity. And none of this is suggestive of, the end of the economy as we know it or anything else. We're just getting back to normal from being so abnormal for so long.
So,
and by the way, you've had no central bank intervention this entire time, mind you.
I don't disagree with what you're saying. There are points of contention that I could throw out there. I don't want to really get wrapped up in it this time. Maybe we'll save it for next time. I guess the only thing I'll say is I'll take your comments about housing as an example for my bigger point here, which is the housing analysts I know are increasingly saying it's not the mortgage rate, it's the price, right? In other words, we have a housing unaffordability, I'll call it a crisis in this country. It could get even worse, as you said earlier, right? That 7% mortgages are not historically crazy, right? They feel like it to folks that were, buying homes at 3%, in recent years. The problem is that the price of the houses have just gotten so high as a multiple of income that at 7%, the house is just unaffordable to the vast majority of potential buyers.
And that's crap.
All right, so you may disagree, but I think, look, 7% mortgages may stay, but prices are going to have to come down at some point.
Yeah, absolutely. And we need to go back to building houses like we built back in realistic times. When you go to afford a house, it's not 3,000 square foot homes with three, 4 bedrooms and all this other nonsense on them. I mean, your starter home should be 1,100, 1,200 square feet, 3 bedrooms, 1.5 bath, basic stuff. You could build that house for $150,000, $200,000 today, easy. And you could get an affordable mortgage to get into it. But see, that's not what we want, because we want all this other stuff, because we watch house flippers every weekend and we see all these amazing homes and everything else. And plus, then you've got to have the internet, you've got to have the iPhone, you got to have all this stuff that you didn't have before. So houses are affordable today. You can afford the house, but you have to be willing, to save up a 20% down payment. You've got to be willing to forego all the other stuff. You can't have the iPhone. You're going to have a flip phone with, a basic cell phone package that's $20, $25 a month. But see, we don't want to do that. we don't want to give up all those other things that people before us and the generations before us didn't have. So that was never an issue because you got to remember incomes were a lot lower in the 60s, the 70s, the 80s than they are today. People are making a lot more money today than they were back then. So housing affordability isn't inaffordable. It's just a function that we aren't willing to structure our lives budgetarily to afford the house. So again,
So
it's a lot of personal preferences over reality. But again, it's to each individual its own. But I know a lot of people today that are buying houses and they can afford them because they're making decent money, they run a good budget, they saved up the down payment, they're buying a house.
So I'm not disagreeing at all with your general societal broad brushstroke point you're making there. I will say I think houses are more unaffordable just price-wise to medium income than they have been for generations. But all my point is to say that as things normalize, there's going to have to be corrections. And I think the housing market's a really good example of that. So I
Oh yeah,
just,
it's going to correct.
because to your point of like, oh, it's okay, everything's just normalizing. Yes, you might be right that we are normalizing more to historical trends. I just want to make sure people realize that, hey, as we normalize, we're going to have some corrections
Yeah,
that a lot of people aren't going to like as part of that process.
absolutely.
Yeah,
Absolutely right. Yeah, you're going to get a housing market crash. Now, you're not going to get a housing market crash, but you're going to have prices just stagnate for a very, very long time, most likely.
right. And you might have crashes in certain areas where inventory is becoming an increasingly big problem, which we're seeing
Yep.
in more and more states now.
Yep.
Okay. All right. So getting back to bonds. So two questions. What's driving the rise? What will bring it down? And it's part of what's driving the rise. This week the headline has been there was a weak 20-year auction, and that was something that the bond market react negatively to. But in your opinion, what has been driving the 10-year up to 4.6, and then why are you confident it's coming down? So confident that you just bought a bunch of 30-year
Well, so first
treasury.
of all, just remember that I'm trading bonds in my portfolio. So I sold the same bonds previously about 3 months ago at a gain, and now I'm buying them back cheaper so that I can make money on the next trade. So again, that's just a function of trading. But let's talk about that bond auction real quick. This is a chart of the 20-year tail. This is what I was like, oh my gosh, it was a disastrous bond auction. It was terrible. Bond auctions tell you absolutely dick nothing about what's going on in the bond market. You can have a bad auction and a good auction 1 week to the next. So it tells you absolutely nothing about what's going on in the bond market. And you're talking about small ticks. This is 2 basis points below what was expected to get the yield was to go off at. So this is very, very minor. And also in that 20-year bond auction, you had 88% of that was bought by foreigners or indirect bidders. So again, it was actually a very good auction for the 20-year treasury, but yes, it came in a little bit lower, but plenty of demand for the bonds, plenty of buyers. There's always going to be buyers to the markets, and bond auctions tell you nothing. One auction to the next can be anywhere. There's no trend to the data that suggests that there's any risk in the bond market whatsoever. But again, this is what I'm talking about. People that run around and start writing all these negative headlines that scare the bejeebers out of people. It really erodes their credibility as individuals because they're just trying to sell a product or a service, whatever it is, rather than giving people the real information. Scaring people into doing something is not a good way to build a business long term.
So, okay, I get you can do that with just regular people, who are impressionable and whatnot. But the bond market's a really big market.
Yeah.
So, I mean, are you saying that a scary headline moved the whole bond market?
Yeah, because you have short players in. We just wrote an article about this in our daily market commentary or just earlier this week here. I'll show you the chart. But you got to remember that from a day-to-day basis, bonds are traded just like stocks. And so if I'm in a position to where I can drive a price in some direction, in one direction or the other, then I'm going to take advantage of it. And so we were going into that 20-year bond auction. So if you ever notice going into a bond auction, yields always rise going into the bond auction. That's because the bond market goes in and they short the bond going into the auction so they can buy it cheaper on the other side. Because remember, primary dealers have to buy the bonds.
Mm-hmm.
There's no choice. So if I can buy them cheaper by driving them down in advance, then immediately the yield goes back up because I sell them out at a profit to my secondary markets. I can make money on that. But we have the largest short position on treasuries right now than we've had pretty much. Well, this is the largest short position ever on treasuries, and these are net position contracts above 100,000 contracts. So this is a huge, huge short position. But you'll notice that every time that you have these very big short positions on treasuries, the subsequent trend for yields is lower, not higher. Because again, once yields start to move down, those shorts have to start covering. But right now, the short market has had control of this bond narrative over the last, kind of year and a half. And they've been able to make a lot of money just forcing this yield to go up or down by just shorting against the market. So again, you have to understand narrative. These narratives don't make a lot of sense because what drives yields long term is economic growth, wages, and inflation. Those are all at 4.5% right now. So yields should be trading at 4.5%. In that range right now, yields are exactly where they should be, fundamentally speaking. But anything outside of that is being driven, and these very sharp moves that you see in yields one way or the other, is being driven by either short covering or shorting of the market.
Okay, that's a fascinating chart. Can you do me a favor? Can you just try to pull it back up for a second and just try to make it a little bit bigger for, our eyesight challenged folks, just because I don't know if I've seen this before, but super useful. It's a little too big. We're kind of missing the most recent
So
year.
just tell me where you want it, because
just shift it to the right a little bit more if you can. Yeah, no, whatever. Just shrink it by.
There you go. There you go.
No, I'm still not seeing it on my end. Okay, so it looks like this is the maximum size we can have here, but super interesting chart, because yeah, it does show, at least since the new millennium, this is the maximum amount of shorts that we've ever had. And shorts eventually get unwound, right? So you could make an argument just from this data alone that bond yields are going to come down perhaps over the next year or two,
if they have to cover
as these shorts get lightened up, right?
Yeah. If something forces the shorts to cover, yields will come down aggressively. And again, so what will that be? Well, that'll be because the Fed has had to step in and cut rates or bail out banks or resume QE, whatever the reason is. But anything that starts to weigh on the bond market in terms of economic weakness, recession growth, recession risk rises, the Fed has to step in. That's going to start to push yields lower because money will move into that. And as yields decline because people are buying bonds, then all of a sudden all those shorts have to cover, which exacerbate. And that's why if you look back at 2018 is a good example. So we remember, so what was happening in 2017, 2018? The Fed was hiking rates. In 2018, we were going to the trade war with China, and the Federal Reserve says, "Oh, we're nowhere close to a neutral rate." And remember now, these red lines that you see coming down, this is when there's more than 100,000 short contracts on the market on net. So these are net short, more than 100,000. So these are when you have a large number of contracts. But in 2018, as the Fed was doing that, they said, so they were shorting heavily. Oh, these rates are going to keep going up. The Fed's hiking rates. They're nowhere neutral. They're going to keep hiking rates. So they were just shorting the bonds like crazy because they could make good money on that. And then the Fed comes out in December and says, yeah, well, on second thought, we're right at the neutral rate. And not only are we neutral rate, we're going to cut rates. And then you had this massive drop in rates going into 2020, and those shorts all had to cover. And look, when you got into 2020, those shorts are gone entirely. That you got the big gap.
And that's kind of my point here, where every time we've had a short, short run or whatever, it is eventually unwound, right? So if you just say, okay, at some point we can argue about when, next month, 3 years from now, the short run's going to start ending, and the shorts are going to have to start getting unwound. That should be very positive for bond prices.
Yep, exactly. And look, and that's why all these narratives in the short term, they're great, right? So you talk about, oh, it's the debt, it's the deficit, whatever it is. And there's actually no economic basis on that. In fact, what more deficits incur is lower yields. In fact, when you reduce the deficit, then you actually get an increase in yield. And we've been reducing the deficit since 2020. So in 2020, at that market low in terms of yields, we had that massive deficit, like $5 trillion. So now we're down to about 2.5 trillion. Well, that was because you're now extracting capital out of the economy. You're getting slower economic growth. So, as you're extracting that capital, then yields are going to rise against that process. So again, less capital spending coming out of government. You're reducing the deficit. That's going to lead to higher yields. And so there's actually the inverse relationship that people say about deficits relative to higher rates. But what's driving rates is that narrative says, okay, so here's the narrative everybody's running around talking about right now. So I'm going to short more bonds because I've got a market tailwind right now with negativity, which allows me to short yields and make money on it. And they're going to keep doing it until that narrative changes.
Okay. All right. I want to get actually to talking more about the national debt and deficits because we just had the big beautiful bill pass the House. So we'll get to that in a second. But a few more things on debt. I just want to note, folks, you'll get the full details of this in tomorrow's interview with Tom McClellan. Tom McClellan actually thinks bond yields will come down in June. So he actually thinks, like you, Lance, this is a good time to be buying them as a trade. Just FYI, he expects them to then start rising after that. And there's this spooky correlation with the price of gold that's time shifted that I won't get into too much, but kind of interesting to watch. So folks, make sure you watch that tomorrow if you're intrigued by that. Okay, also about debt is we've seen bond yields explode higher in Japan recently as well. So I guess short question for you, Lance, is how important is this?
What's going on in Japan? So two things you've got going on, both in the US and Japan, is no central bank intervention, right? So yields are a function of inflation. And inflation in Japan is going up because the price of rice is going up dramatically. And so that's creating a inflation pressure on Japan. That'll go away when we resolve the tariff issues with Japan. Because remember, there's a huge tariff on our rice in Japan. So once that tariff gets resolved with Japan, the price of rice will come down. That'll solve the inflation pressure there. But when you take a look at Japan, kind of historically speaking, they don't have any economic growth. Inflation's up a little bit. It's 3% inflation, but economic growth is barely positive, and 10-year yields are under 1%. So, their economic and they don't have, and Bank of Japan isn't intervening right now to any great degree. So at some point, the Bank of Japan will have to start to intervene in the bond market again. That'll bring those yields down. But, and at the same time here, we don't have any central bank intervention. We have the opposite, right? We've got a central bank that's not intervening. They're tightening the balance sheet and they're keeping interest rates high. But at some point when they step in, that'll start to bring rates down too. So that's just a function of markets normalizing right now without that central bank intervention.
All right. So I've got two main questions about this. One is we saw concerns last year about the carry trade blowing up and the direction that yields are heading in Japan right now are unfavorable to the carry trade. How concerned should we be about an unwind of the carry trade now?
It's a lot less of a risk than we had back in last year when it happened in August of last year or July of last year. It's a lot less because that jump in the carry trade was unexpected. It just happened overnight. This has been much more gradual. And there's also, so they've already known that was coming to some degree. So a lot of that carry trade was already unwound, set off. And again, when things move slowly, it's okay because markets can adapt. It's when it occurs very quickly, like literally overnight, that it catches markets by surprise. So that risk of a carry trade unwind is a lot less than it was in August of last year.
Okay, so we're at less risk of people getting caught unawares by this, like we saw last year.
Yeah.
Okay. Now, is the risk zero? Don't worry about it, or is it just we know it's not going to be as bad as it was?
No, it's not zero, but it's a lot lower. It's the risk of a carry trade is probably 20%. And again, what we have to do is wake up one morning and see a really big jump in rates or the currency, whatever. But we need to see some kind of really kind of decoupling that would cause that unwind to occur. But but again, a lot of that's already been priced in, and markets have already kind of hedged for that to a large degree. So they're seeing what's going on, and they're mitigating the risk because of that.
Okay. Is it a factor why U.S. yields have been going up or not at all,
Yeah,
do you think?
well, it could
Yeah.
be.
Okay.
Yeah, because it's the whole deal is I short I'm shorting one bond, going long the other bond, and I'm capturing the spread in between. Well, that spread used to be really big. It was like 4% of the U.S. Treasury and zero on the Japanese bond. Now the Japanese bond is basically about one or two or three, depending on which bond you're using, and so that spread's a lot tighter. So it's not as advantageous as it was before.
Okay. All right. My second question, and I've been asking this a fair amount recently. I'm curious to get your answer. So you have people out there who say, you know, U.S. debt, U.S. treasuries, they're slouching into decline. The world doesn't want them anymore. The U.S. has a bunch of problems, all that stuff, right?
Mhm.
And to a certain extent, I think we are seeing the world cool a bit on U.S. treasuries. If you look at central banks, right, they are buying gold at a greater rate than they are buying treasuries, right?
Mhm.
So they've cooled some of their treasury buying, and of course it differs country by country. They've increased their gold buying. So to a certain extent, there's a little bit of substitute or replacement of treasuries with gold, but there's a lot of players out there, sovereign nations and a bunch of other, institutions that have to play in the debt market. And my question is if you have to play in the debt market and you want to own super safe sovereign bonds,
Mhm.
who else's debt are you going to buy over the US's?
Nobody's, and that's why foreign buyers. We just got the report for March. We've had near record foreign buyers for U.S. Treasuries, and yeah, central banks right now are buying gold, and why wouldn't you, right? So I've got two choices to reserve to store my reserves in U.S. dollars. I can buy Treasuries or I can buy gold because both of those trade in dollars. So if I need to store reserves right now because prices of bonds are going down and yields are going up, I'm going to buy gold because I don't have to worry about the currency exchange. At some point when yields start to decline, and I told you this, I told you this before, is that gold will become a liquidity source for central banks to buy treasuries. And so that flow will reverse. They'll sell gold, they'll take the profit on that, and then they'll buy treasuries that are declining in yield, and those prices are going up. So once the price of gold begins to decline in earnest, it now becomes the liquidity asset, where right now treasuries are the liquidity asset to buy gold, but that's just a function of reserve storage. And so it's just a question of where do I store my reserves? I have choices, and so it's a function of maintaining my purchasing power parity, as well as restoring my reserve balances.
Okay. And really just sort of want to underscore here is for people out there who are attracted to the narrative of, the US dollar is dying, it's going to lose its world reserve currency status, and foreigners don't want to hold our dollar denominated debt, yada, 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 yada. Then you have to ask yourself, okay, then what are they going to replace it with? And
Right.
right now, to a limited extent, they are increasing their gold holdings. But from a debt perspective, yeah, what are you going to swap? Like whose debt looks better? And that's my point. There's no like darling out there in the sovereign debt market. And of course, it's a short list because you have to be of a certain size and depth to play the role that the U.S. Treasury does globally.
Well, and if they're buying gold, they're buying dollars, right? So that whole narrative has no basis of reality in it because, again, if I'm a central bank and I'm buying gold, I'm buying US dollars. I'm not buying gold, I'm buying US dollars. That's how I'm storing my yuan or my French franc or my UK pound. I'm storing it in US dollars by buying gold because gold trades in dollars everywhere in the world. So again, the whole narrative is that, oh, they don't want our dollars. Well, if they're buying gold, they want our dollars because that's what they're paying for it with.
Okay. So yeah, again, I just want to caution people, look, you trade however you think or invest
Yeah.
however you think, but be cautious about writing off the US Treasury market.
Yeah.
Okay. We don't have a lot of time left, Lance. I got some big topics, so I'm going to start pushing most of them to next week.
Speed round.
This one's going to be a little hard to do speed around, but we'll kind of
Okay.
end on it. If we can squeeze a rant in, great. If we can't, we'll just do it next week. So as I mentioned earlier, a large development this week was that Trump's big, beautiful bill passed the House.
Mhm.
right? Um, and here's the criticism of it. Well, first, let me say what's in it. Okay.
Okay.
Here's how Trump is selling it. The bill includes massive tax cuts, no tax on tips, no tax on overtime, tax deductions when you purchase an American-made vehicle, strong border security measures, pay raises for our ICE and Border Patrol agents, funding for the Golden Dome, Trump savings accounts for newborn babies, and much more! Exclamation point. In addition to that, there's state and local tax SALT deduction cap will be increased to $40,000 with phase out for high earners. There are going to be cuts to safety net programs such as Medicaid and food stamps, alongside new work requirements. Rollbacks on clean energy tax credits, boosting of fossil fuel incentives, major increases in military and border security spending, new taxes targeting elite universities and immigrant remittances, and the elimination of EV tax credits, and that's going to be replaced by the interest deductions on US built vehicles. So those are kind of the major provisions. Now, a
Well,
lot
hold
of
on.
the,
I want to fix one of those real quick.
yep,
There are no cuts to Medicare and Medicaid. Zero. Nobody's cutting Medicare and Medicaid. They are applying a work requirement. If you are collecting Medicare and Medicaid, because you say, you're not of age, right? You're in one of the other remember, we've been adding people to the Medicare Medicaid rolls of all different classes over the years: widows, orphans, firemen, you name it. So they're simply saying that if you're in that class of individuals who are not in retirement, you're going to have a work requirement in order to collect Medicare Medicaid. So there are no this has been a bunch of headlines coming out of the left media going, oh, they're going after Medicare. No, they're just getting rid of people that are basically fraudulently collecting Medicare and Medicaid.
true. And there may be, and don't quote me on this, but there may be some other DOGE related cuts to the organization, but not to the payouts that you're
That
talking
is
about.
correct.
Right?
Yeah,
Yeah.
but both Richard Rosso and I went through all 430 pages of that bill, and then we ran it through AI just to double check to make sure we didn't miss anything. But there are no cuts to people's payouts of Medicare and Medicaid. So
Right. To
nobody's taking away your
qualifying
Medicare.
to qualifying people's payouts, and they are
Correct.
redefining qualifying now, right? Yeah.
Correct.
Okay. So, I would say the biggest criticism that I have seen so far to the bill as proposed is, from budget hawks. They just think, look, this is not does not appear to tackle the existential issue. And I know you think maybe a little bit differently about the word existential, Lance, but of runaway debt and deficit spending. So the Committee for a Responsible Federal Budget estimates that the bill would add uh, was it 3.3 trillion to the debt, including interest, or 5.2 trillion if its temporary provisions are made permanent. Deutsche Bank says there appears to be no serious efforts at reining in historically elevated deficits, which remain on track to exceed over 6% of GDP in coming years. And in fiscal year 2027, the deficit boost represents a 1/3 increase in total projected deficits. Um, so, a lot of people who said, hey, I really thought this administration was really going to try to get the deficit managed and, work on at least slowing the growth of debt
Mhm.
in the immediate term, like most other bills that come out of Congress. This seems to really front load the borrowing and the spending, and then sort of says, well, we hope to get under control in later years. So do you have a
Well,
reaction to that?
yeah, tons of fallacies about, first of all, the calculations on a lot of this stuff is that what they do is they take the current projections or they take the current spending runs that we have and they just project those in the future. And that's why they're always a straight line going straight out into the future. It's like,
Mhm.
if you look at the budget deficit, it's just going to go straight line up, 45-degree angle. Very scary stuff, right? Very scary stuff. A little bit of reality here. First of all, the US trades at about 118% of debt to GDP. Japan is at 250% of debt to GDP. They are still alive. They are still kicking. They are not bankrupt and they haven't collapsed into economic ruin. I'm not saying that's a good thing, by the way.
Yeah.
Increased debts and deficits lead to, let me finish,
Like
lead to,
saying, I'm not taking as much meth as that next guy, but yeah, go ahead.
yeah, no, but I mean, you got to keep things in somewhat of perspective. And again, these narratives are just simply stupid in a lot of cases. But here's the deficit in the U.S. So we've had this massive reduction in the deficit since 2020. And like I told you before, deficits lead to lower interest rates, not higher. When you have basically reversals of the deficits, that's when you get pickup in yield. So the more debt you have, the more deficits you have, the slower your rate of economic growth. And you can see that, clearly as we continue to have, increasing deficits, we've had slower rates of economic growth. So what everybody just projects now is that rate is just going to continue. What we don't look at is we don't account for things like changes to current spending programs that expire. We don't look at future changes to regulatory issues and the impact on economic growth you're going to get from deregulation. We don't include the fact that when you pass tax cuts, you tend to get an increase in revenue growth in the country. So here's a picture of so this is revenue. So this is the 3 previous tax cut bills we've had. So going back to the Economic Recovery Act in 1981, the Tax Reform Act in 1986, the 2017 Tax Cuts and Job Acts, you've had increases in revenue after following every one of those issues. So we don't count that, right? We just say, okay, well, it's just going to be a net negative into the future. We don't count on increased revenue growth. We don't account on increased economic growth. So if we can cut taxes and if we can reduce regulation and we can do the things that he wants to do, we should expect the economy to at least grow stronger than it was previously, because you should be creating more revenue within the economy, people keeping more of their money, spending more of their money in the economy. But see, we don't include any of that in those future projections. We just assume the debt run continues as it is forever in the future. So, again, there's so many problems with these projections that just a little bit of math and a little bit of thinking just immediately refutes them.
Okay, and
And
I
that's
was
why,
going
and
to
by
go
the way,
there.
and that's why, by the way, the CBO has never been right about one of their predictions ever. So, that's the other problem with the CBO.
Yeah, true. And I don't think there's a government agency out there that has a great track record of predictions that have held up. I will say, though, the CBO has always under predicted the debt
No,
accumulation.
not at all. In 2000, they predicted a $1 trillion budget increase. We came in a $1 trillion deficit. So yeah, it's just a $2 trillion swing. But
Right. Yep.
whether they've been positive or negative, they've never been even close to accurate. Because look, think about it this way. If weather forecasters can't predict accurately for more than 3 days, how can you predict anything 10 years into the future? It makes absolutely no sense whatsoever. There's nobody can predict anything much 6 months in the future, much less 10 years.
Yeah. All right. Well, look, I just want to underscore the point you made there, which is the projections that I had read earlier. You're correct. I don't know how much they have, if at all, lifts to growth based upon the current policies of the new administration. But they have said that, hey, this whole, either the deficit or the new debt we think is going to be taken on, it could be smaller if tariff revenues come in higher, or if growth is spurred by these policies higher than is currently estimated, which is kind of what you're saying there, Lance, right?
Yeah.
I don't know if they're including 0% if they have their own estimates, but they're basically saying, look, if these policies are as successful as the administration thinks, then yeah, this may not look as bad as it's going to. And I guess this is what I want to say is in many ways, this is a gamble, and it's, I think, the intelligent gamble every administration takes. I'm going to embrace a set of policies, and I think we're going to be better off in the future for them. There is going to be some cost to these policies that we're going to take on here in the short term, so the benefits better show up, or else we're going to, be in trouble going forward.
Mm-hmm.
Well, I guess we'll see. We'll keep tracking here, and of course, and a big part of this too is also just sadly, you got to kind of horse trade to get enough of what you want in the bill out. You're never going to get exactly what you want, right?
Well, just like he had to increase the SALT tax deduction to 40 grand to get Democrats to vote for it. So, that's a huge benefit to blue states like California, where you can deduct state and local taxes. I don't have that, right? I don't have an income tax. So I get nothing out of that bill in terms of the SALT tax versus you, who can now get a $40,000 deduction. So I don't know why you want to move to Nevada now, because you've got, that's you've got a huge tax deduction coming your way. But the other big impact of this, Adam, is that let's just run it the other way for a second. Let's just say that they came out with a bill and says we're going to slash deficits, we're going to cut the debt, we're going to stop spending, we're going to just slash and burn all of these programs. And you go, great, we're gonna get the economy, we're gonna get a budget surplus. That's gonna be awesome. At the same time, you're gonna be in a recession that makes the
Yeah.
financial crisis look like a cakewalk.
Yeah, you'll send the economy into cardiac arrest from that. Now, there are some people who would say, fine, let's just take that pain
Yeah. Those are the same people that were in 2008 panicking because they were losing their job, their house, and everything else. So,
yeah.
people that say that nonsense have no grasp of reality. And it's all fine and dandy as long as you're living in your lifestyle right now. Everything's fine and dandy. It's like, yeah, we just need to let it all come down and need to just have a reset. Sounds awesome until your ass is living out on the street and you've got no money, no job, and no future. But hey, go for it. Let's do that reset.
If you're watching this program and you feel like you're on Team Reset, and there are days where I feel like I'm on it too, Lance, I agree with you that a lot of people, great in theory, in practice, they might change their minds.
Yeah.
The problem, though, is that those people are going to always be a tiny minority, right? The vast
Yeah.
majority of the populace and almost all politicians are going to be wanting the other side of that. So
And look, and here's where I do agree with you. Do we need to start cutting spending? Do we need to get rid? Look, I was a huge fan of Doji. I mean, let's get Doge in there. Let's just go through the books. I'm a huge, one of my favorite movies ever was Dave. Did you ever see that movie?
Yeah.
Yeah, Kevin Kline goes in, he's an accountant, goes into the White House. He's a fake president because the other president had an aneurysm. He's like an exact duplicate. So if you ever get a chance, watch the movie. It's a hysterical movie. It's really funny.
He's supposed to be a placeholder, but then
Yeah. And so he winds up being president. But he's tasked with finding $600 million because he wants to fund this one particular program. And the guy says, well, if you can find it in the budget, you can do it. So he sits down with a red marker and just starts going through. And I was like, dude, this is great. If Doge can do that, just get rid of some of the waste and just the bad accounting and things that we have going on, that's great. I mean, we should all just want a much more transparent, operationally efficient government, not just wasting our tax dollars. So I'm a huge fan of cutting spending and getting debt down. That would be awesome. But again, this whole idea of just this whole economic resets, the end of the world type thing, it's just so far out in the realm of the ether. It's great for selling headlines and getting clicks and views, but and just scaring people into making bad decisions. But at the end of the day, it's just not realistic.
Well, and so speaking of kind of what's practical, right? Like or reality based. Should we expect this big beautiful bill to pass?
I don't think it will.
You don't think it will? Okay,
No.
but so let me ask you this: why? Which is, it includes the extension of the tax cuts from Trump administration 1.0.
Yep.
Could we, as a country, willingly absorb the tax increase that if those weren't allowed to,
it would hurt.
Continue.
Yeah. If you increase taxes on individuals, it's less consumption, right? So, I mean, I'm doing an article.
But I mean, is our political class going to say, yeah, hey, Americans, your taxes are jumping up now?
Yeah. And again, it's going to hurt corporate earnings. I'm doing an article for next week on personal consumption expenditures versus earnings. There's a super high correlation between those two because consumption is where earnings come from. So if you do anything to decrease consumption, you're going to impact earnings. That's going to impact the markets. It's going to slow the economy. You get the wealth effect reverse, those type of things. It's all not good. But I don't think the bill is going to pass. The reason is that there's a 53-47 majority in the Senate. And there's a bunch of contentious stuff with the Democrats and even for some Republicans that really, remember in the House, we have the Freedom Caucus, they're the deficit hawks. They're all over this. And so you got some of the same people up in the Senate. And so and I'm not saying with absolute certainty it won't pass. I think there's a very high risk. One of two things happen. Either A, they lose 3 votes, and they can't get it to pass. So actually, have to lose 4 votes because JD Vance is the tiebreaker. So if they lose 4 Republican senators, the Democrats are going to vote against it. Period. So you can just already count 47 no's against 53 yeses. You lose 4, bill doesn't pass, and even with a tiebreaker, you can't fix it. The other option is, and the more realistic issue that becomes problematic, is that the Senate makes some changes to it. This is what's called reconciliation.
Yep.
The Senate makes some changes. They go, well, we're going to change this one aspect on EVs or whatever. There's a bunch of cuts to EV credits. There's, a bunch of stuff that the Democrats really, really favor. And so there's potentially going to have to be some negotiation in the Senate to get it to pass the Senate. Well, if it passes the Senate, it's then got to go back to the House to get a vote. They only passed it by 1 vote in the House. So that means if you lose just 1 guy on that reconciliation process, bill's dead. So there's a very high probability that the big beautiful bill that's passed now either A, won't pass, or if it does pass, is going to be vastly different than what it looks like right now.
All right. So I'm going to ask my question one last way, and then we'll wrap up.
Sure.
I don't see how the tax extensions don't get passed, regardless of what they might strip out of the rest of the bill, because I just don't see the populace being willing to accept that, and I don't see politicians wanting to go on record to say, yeah, I forced a massive tax hike.
That would be worse for the Democrats than for the Republicans right now. Because again, the reason I say that is that the vast majority of the Republicans are voting for the bill. You've got a few little holdouts, right? But almost every Democrat is voting against the bill. So, if they somehow, that this bill fails, it's going to fall at the feet of the Democrats, and come midterm elections and people are paying a lot higher taxes, that potentially plays out worse for the Democrats in the midterms than it does for the Republicans.
Right. And that's why I think the bill is going to pass, maybe not as is, but some variation, because I just don't see those tax cuts getting.
I don't disagree with that. But I don't think it's going to look, and I could be wrong. This thing could just sail right through. Again, if they only lose 2 votes in the Senate, or even 3, JD Vance can do the tie break on it, and it passes, it's done, it goes to the president for signing, and he signs it. So there's a possibility this gets passed. I'm just saying, I just think there's enough contentious issue in there that this somehow winds up in reconciliation and becomes a problem. And again, don't forget, we got recess coming up for the summer for Congress. So if it doesn't get passed pretty soon, we got a problem with the debt ceiling again and the funding for the budget for next year, which is October.
Yeah. Okay. Well, look, because we have our hard stop, Lance, I'm going to have to end it there. I'm kind of lamenting some of these other great topics, but maybe we'll get to them next week.
Just make a list.
Yeah, well, I've got it. So we'll just pick this up next week. All right. So sorry, but trades, I can't let you go without you. Beyond Apple, what other trades did you guys make?
So we sold a short position. We sold Apple entirely. I almost, not quite, but I probably increased my bond position by about 50% in the portfolio. It went from 6% to 10%. So yeah, it's about 70% increase. And then we trimmed off Palantir, Google, Microsoft, and one more stock. I trimmed 4 today. Google, Microsoft, Apple, and NVIDIA, because NVIDIA reports earnings next Wednesday. So we reduced it back to target weight.
Okay. So those last ones, Palantir, Google, Microsoft, NVIDIA,
they were overweight.
Trimming, position sizing like you always do. Apple, you're getting out of the position, increased your long bonds. Sorry, what did you say about your short positions?
Oh, we sold it. We took the hedge off entirely. Day early. I got trumped on Friday morning.
So why, I'm just curious though, why did you take it off if you think that a correction in the near term is more likely?
I thought it looked like we were going to set up for more of a consolidation, just where we were flopping around sideways. And the problem with the short position is that it just erodes market performance when it doesn't go anywhere. So it's, and the Trump announcement this morning, we were taking it off, we raised cash and added the bonds, which are acting as the hedge right now. So I just basically swapped. It was an even swap. I took off the SH and I added the bond position. So it was almost an equal swap. Which is working. I mean, the bonds are working. They've been hedging nicely for the last couple of days. So, I didn't really remove it. I just swapped how I was hedging the portfolio.
Okay, but you are now out of your short positions fully?
Yeah.
Okay.
Yeah.
All
Again,
right.
day early, but stuff happens.
All right. Well, look, folks, if you think the best way to hedge against any unpleasantry in life is to continue to watch Lance Roberts on this channel week in and week out, please let him know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. And if you would like some professional help in navigating these volatile markets, if you don't already have a good financial advisor who is doing that for you, consider scheduling a free consultation with one of the ones that Thoughtful Money endorses, perhaps Lance himself and his team there at RAA. To do that, just fill out the short form at thoughtfulmoney.com. Only takes you a couple seconds, and the firms will be in touch with you right after you fill out the form. Lance, it's been wonderful, my friend. Look forward to getting next week to all the stuff we didn't get to this week.
Yeah,
But thanks so
we
much,
can do a
brother.
long I promise you next week we can do a long one if you want. So I will reserve some time for you.
All right, my friend. I'll look forward to it. And in the interim, everybody else, thanks so much for watching.